bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the December 9th, 2025 episode. My guest this week is Nicolo Pinoli, a partner in Novogradac's Portland, Oregon office. Nicolo is here today to discuss a way to incentivize development of for-sale housing in distressed neighborhoods. Now, it's not the neighborhood homes tax credit, which of course is a proposal that is designed to encourage development and renovation of such homes, but has not yet been enacted into tax law. Instead, Nicolo is here to discuss how you can use new markets tax credits to fund for-sale housing, an approach that's been used dozens of times since the new markets tax credit became law 25 years ago. Now, I can imagine some of our listeners thinking to themselves, wait a minute, new markets tax credit can't be used for residential real estate. Technically, new market tax credits cannot be used for residential rental real estate. And even at that, it can be used for residential rental real estate if it's mixed-use housing, or more than 20% of the income is coming from non-residential rental real estate. But that said, Nicolo isn't here to talk about residential rental real estate. He's here to discuss residential for-sale homes that not only help families build wealth, but it also helps to strengthen those communities in which the homes are built. Now, this topic is going to be discussed in considerably more detail in a panel at Novogradac's 2026 New Markets Tax Credit Conference. That's January 22nd and 23rd in San Diego. Nicolo is the chair of that conference, so you can consider this podcast an appetizer for the main course of the conference as a whole in the hour-long session in San Diego on new markets tax credits and single-family home building. Now, with all that's happening in the new markets tax credit area, including permanence and the hopefully soon, I'm not sure what soon means, announcement of the $10 billion allocation round awards, as well as the upcoming opening of the calendar year 2026 round, there's clearly a lot happening in the new market tax credit community development area. I encourage our audience to register for the New Market Tax Credit Conference. I encourage you to register soon, as oftentimes the rooms at the hotel get booked. I'll also share a link to register in today's show notes. Now, getting back to today's podcast, Nicolo and I are going to discuss for-sale housing financed by new market tax credits with a focus on technically how the incentive is used to build for-sale housing. We'll also run through what a community or a CDE, what an investor, as well as the various qualified businesses qualifying as home builders eligible to receive the new market tax credit subsidy, what those various stakeholders should know. As you can hear, and those of you on YouTube, you can see that Nicolo's here waiting to join the conversation. We have a lot to discuss. So if you're ready, let's get started. Nicolo, welcome back to Tax Credit Tuesday. You're getting to be quite the regular. It's your 11th appearance on the podcast, which puts you 6th in terms of guest appearances, but you are making up ground quickly. This is the 4th time you've been on the show since July, and I appreciate it very much. Thanks for joining.
Thanks for having me, Mike. I've always been a bit of a late bloomer, and it's been no different when it comes to the podcast, but it is definitely nice to be firmly in the double-digit club now.
I'll have to, at some point, have you be a guest host as well.
Fun.
Now, before we dive into today's topic, please share with our audience some of the many services you provide to Novogradac clients. I say some because we could do a whole podcast on all the services you provide to Novogradac clients.
Right, would be here all day, but just to keep it brief, when you think especially about for-sale housing and the role that we usually play, a lot of our services are very focused on helping clients to structure their deals, obviously in coordination with legal counsel, to make sure that their transactions fit within the NMTC regulatory framework. Additionally, we do a lot of work with providing reports in connection with closing, including New Markets Forecast Compilation Reports, QALICB AUPs or Agreed Upon Procedures reports, as well as other work helping clients to document their ongoing compliance. Speaking of which, We also work quite a bit on a post-closing basis with clients to help them do boring accounting stuff like audits and tax returns, as well as more exciting new market specific reports, such as documenting that they are continuing to meet the QALICB requirements on an ongoing basis. So that's about it for now, at least.
Great. Thank you for that. Now let's just dive right in. So I explained in the intro that we're not talking about residential rental real estate. So that prohibition doesn't apply when you're dealing with development of for sale housing being supported by new markets tax credits. However, you do have to be the business that a community development entity invests in, does have to be a qualified active long-term community business during the full 7-year compliance period, as well as can't violate a non-qualified financial property test. So maybe you could start by explaining how the development and sale of single-family homes can meet the definition of qualified active low-income community business over the full 7-year term of the tax credits. That's a pretty expansive question. So if you can give some of the Cliff Note versions of some of the points, because I know you'll go into more detail during the session in San Diego.
Sure, let's hit some of the highlights. And you paused and lingered over the word active.
I did.
A little bit for good reason. And I think part of the fun when it comes to for sale housing is there are two broad models. One model involves building one development, selling the homes, and then carrying back a promissory note in connection with the sale, and on an ongoing basis, then servicing those loans. And usually you need to have something else, because merely sort of clipping coupons related to carrying back those loans probably isn't enough to really be active on an ongoing basis. So most attorneys and participants in the program really want to see our QALICB more actively providing services related to homeownership supports. And certainly one way to do that is to have sort of a larger nonprofit who is very involved in homeownership in the community that's providing those services, either as a QALICB or in providing those services on behalf of the QALICB to the local community. So that's one way, one of the common ways to meet the active requirement. I think one of the other common ways is to never really stop developing. I'll go ahead and go in and develop one set of homes, and maybe it's 5 or 10 or 15 homes. And as I'm getting done wrapping up that first group of homes and selling those off, then I'll move on to a second development. And that way you continue rolling your money over every few years, maybe every 18 months to 2 years, as you do the serial development from one location to another. Obviously, a little more exciting in order to make sure that you can actually meet that sort of a pipeline and manage all the logistics. But I think those are sort of the two broad approaches to making sure that the QALICB remains active. Now, Mike, you brought up the NQFP, or non-qualified financial property issue. And many of you who are familiar with NQFP, when you heard me describe this notion of carrying back a note, these little red flags started going off in your head, and you started thinking, wait a minute, isn't that financial property? And there's actually an exception to the general rule that says that if you have accounts or notes receivable that are received in the normal course of business in connection with the sale of assets that are carried on your balance sheet as inventory, that those particular notes or accounts receivable do not count as non-qualified financial property. So that's why you can have a QALICB who uses that structure and still meets, or still continues to not fail the NQFP requirements related to a QALICB. I think there's a few other wrinkles and elements that come into play that maybe I'll just mention briefly. And observe that some projects are done on a new construction basis. I also have had some that are ACT rehabs. So you don't have to choose, you can do either one, obviously. And in theory, you could even mix and match within one QALICB, do some of each. There's certainly no requirement that you have to choose just one. The other element, at least as far as I look at it, these tend to be a little bit smaller transactions, mostly because there's sort of limited ability to really scale up and do gigantic transactions with hundreds or thousands of homes. Most QALICBs are try to keep it small, maybe with 10 or 15 or 20 homes in any given development. Now, if they're doing serial development, they might turn that over a few times. And so be able to turn over their money and be able to develop 30 or 60 or maybe even 90 homes over the course of the full 7-year new markets compliance period. But often you find that transactions that use this for sale housing approach tend to be more in the $5 to $10 million range rather than 20, 30, $50 million. I will also observe that a lot of the deals tend to be single family homes, but somewhat intriguingly, I've actually closed a deal that used duplexes. This deal was in New Jersey in Essex County. And as part of that unique structure, the idea was we'll build a home for this family to move into. They'll actually own the whole duplex. They'll live in one side. They'll lease out the other side to another local family. And that way you're doing sort of two things. One, they get to build wealth, not only as a homeowner, but also as a landlord. And also I think there's the added wrinkle where you've got these local families now serving as landlords within the community and able to help further influence for good the community as a kinder, gentler sort of landlord within the community. I do think there's also a bit of fun math that goes on with these deals that I'll highlight briefly, because the homeowners have to be low-income persons. And within the new markets regulatory regime, at least 20% of the buyers have to be low income, meaning at or below 80% of AMI. However, in my experience, most CDEs and tax credit investors really want to see 100% of the homeowners be low-income persons. And I think the QALICBs are very focused on that as well. But what that does mean is you start looking at the math and saying, in my area, how much is AMI? And in order to be affordable, the homeowners can only be spending 30% of their income on their homeownership payments. And so then you can, based on interest rates and based on the payment schedule you get for that mortgage, then you can start to back into the price that you have in order to actually go out and build the house. And so I think there's some exciting math there to make sure that by the end of the day, you can actually sell these homes to people such that they'll be affordable at 80% or below of AMI.
Yeah. So a financial feasibility check.
Absolutely.
So when you think of the two approaches, as you described, one, a business could identify a site where they could build, say, 20 homes, and they build these 20 homes, and then they sell the homes as they're building them over a few years. And I can see how that's easy enough to underwrite up front because you know what the land costs are, you estimate your building costs. I just said you check and see what a buyer could afford to pay, get the financing to work. And then the business could then sell the homes, carry back paper. And then that paper, as you point out, is, I'm going to call it qualified financial property versus not non-qualified financial property. So that isn't, a bad asset. But then you were mentioning that you have to stay in active business over the balance of the 7 years. And that's often done by providing home ownership services and counseling and the rest, so that there's this active business that I guess morphs from being a home builder into this active business of counseling and providing assistance to the homeowners. And then you said the other model is the version where maybe you take that same, tract of land, and instead of building it out over a couple of years, you're building it out over 7 years. So you've got that business of home building throughout the full 7 years. What are some of the pros and cons of the two approaches? And is there one that you see more than the other? And I realize you can't go through all the pros and cons, so just making a couple of general observations works for this podcast. You can go to more detail on the panel in San Diego.
Certainly my experience is a single round of development followed by carrying back a note tends to be more common. And I think part of that is just the logistics tend to be easier. I think if you're doing the serial development approach, often you may not have enough land to be able to do serial development. So often you're having to bounce from one location to another and make sure that everything works every time you're doing another one of these deals. And I think for many groups, it can be difficult to have a pipeline that far in advance to be able to actually do that, have the confidence that I'm going to be able to do that, which is not to say it can't be done, but certainly it's a unique situation and requires a little more underwriting, a little more faith on behalf of the participants that you're actually going to be able to execute on that vision. And obviously, a lot of it comes down to your track record and your organization's ability to demonstrate that you actually can execute on that vision.
Thank you for that. I mean, the second approach where you're basically home building throughout the 7 years, some ways to kind of look at that and think that's more of a, well, theoretically it could work this way, but the market challenges are such that it's more rare. And as I say that, I'm looking forward to the comment on our podcast notes where someone says, that's what I do. So
I'm sure we'll get some.
So thank you for that overview. And you definitely made it sound simple, but it's obviously not that simple. And one of the ways we can tease out some of the lack of simplicity is by looking at the various stakeholders and what they should be mindful of. And let's start with the CDE. So I'm this community development entity. I have a new market tax credit award, and I'm looking to invest in a qualified business that is going to be developing and selling single-family homes in local communities. Beyond what you've shared now, what are some of the key aspects of this that I should be thinking about in my role as a community development entity that has a new market tax credit allocation award?
Yeah, to maybe couch it in really simple terms, in some ways it might be a little bit more work, but I would suspect that most of the CDEs who actually complete these transactions find it to be a lot more rewarding. And so for those who actually are able to close these transactions and actually deliver these homes, it tends to be a really impactful way to impact these low-income communities. So let's talk a little bit about a little of the extra work that you get to do as a CDE. Certainly one of the extra elements we've hinted at, which is around underwriting and gaining confidence around the project sponsor's ability to deliver, their ability to support the QALICB on an ongoing basis. And I think that aspect is a little bit unique compared to your average sort of one-off larger new markets transaction, where there's probably a little more underwriting work that does need to go in, or maybe just a slightly different twist on the underwriting that you're doing. Instead of just being focused on one big building or one larger project, now you're focused on much smaller individual homes. And a lot of that tends to be very focused on the project sponsor and their ability to execute. I think on an ongoing basis, post-closing, my experience is the ongoing asset management tends to be a little bit more work simply because there's more going on at the QALICB level. There's more action, more activity. They're doing more stuff. They're building more things, and there's more moving parts to keep track of. And that's especially true if you're talking about the serial development model, where throughout the entire 7 years, you're busy out there building, and you're never really stopping. And as a result, there tends to be a little more that's involved in that asset management on an ongoing basis. Also want to highlight for all of you CDEs, there is a section in the new markets application where you can actually identify that one of the community outcomes you're going to deliver is housing. And that is a box you need to make sure that you're checking on your application. To the extent that you're not checking that box on the application, then you would need to rely on your 15% carve within your allocation agreement that allows you to diverge in terms of your general strategy in the application. Obviously, that also means you might have to do a smaller transaction. If you only received a $30 million allocation, 15% of 30 million is only $4.5 million. So as a result, there can be some sizing issues that come into play. I do find that it's not uncommon for a CDE who maybe has been thinking about this, maybe works in an adjacent area and thinks, I'm not going to use my 15% carve for something else. I'll go ahead and use it here. Once I successfully execute, then maybe in successive rounds, I'll go ahead and check that box and include it as part of my strategy on an ongoing basis. And I have seen many of my clients have success that way. A couple of last things I like to think about is the subsidy. The tax credit generates a subsidy. And part of the fun is, how is that subsidy going to be used? For example, are you going to use it to buy down the price of the homes? Or alternatively, are you going to use it to maybe sink into a B note that you carry back as part of that carryback provision related to selling the homes? I think those are two options. Obviously, if you're doing the serial development, then you have more exciting decisions around, do I sink a little bit into every house, either in terms of buying it down or in terms of carrying back a little B note? And I think those are exciting decisions. Part of the fun of doing these deals is deciding how we're going to lavish this new market subsidy when it comes to these homes and spread it around the various homeowners. And I think the final thing I mentioned at the outset, one of the really fun aspects is then seeing the outcomes, seeing the impact that you have on the communities where you're performing and delivering on these home ownership transactions. And many CDEs, I think, really appreciate the unique angle on community outcomes, including the deep impacts for the families that buy these units, the wealth creation opportunities that come with this housing, not to mention, I think, the real deep impacts on the local community that comes with having additional local homeowners and these distressed communities really being bolstered and strengthened in additional ways. And I think oftentimes on the outside looking in, we may not really fully appreciate just how beneficial home ownership can be in terms of the benefits to the wider community from that additional grounding and pride of place that these home ownership transactions can deliver.
Thank you for that. I totally concur. I also want to ask you about some of the other participants. And I kind of envision three other key participants, one being the investor, one being the business itself, and then the third one being, of course, the homeowner. So I'd like to get your perspective as to what each of these others, and let's start with the investor. So I'm an investor, and that means I'm likely investing in a fund as a leverage structure directly in a CDE that's then going to be investing in a qualified business. What additional considerations do I have as an investor if I'm looking at one of these transactions?
Sure. And I think when I think about investors, for the most part, their risk is really tied to new markets compliance and specifically related to potential recapture. And so for investors, that's got to be job one, is making sure that they really fully understand and underwrite the QALICB's ability to execute on their plans. And this often really means getting very comfortable with the sponsor and their capacity to support the project and to see it through. I also think this is somewhat of a unique asset class. It's a little different than many other asset classes we're used to in new markets land. And so I do think that there are some unique new markets compliance risks that come with for sale housing, especially if the QALICB is planning to use the serial development model. And so I do think for most investors, it's an important step internally to get really comfortable and feel confident with this new asset class. I think the last thing for investors that I would highlight is often in new markets, and I can say this as an accountant who spends a lot of time developing forecasts, and Mike and I personally together worked on several forecasts in the past where everything has been known to the penny, exactly where every single penny is going on any given day. And there is very little opportunity for variance. And I think sometimes in new markets land, we get so wedded to this idea that we know exactly what's happening and when it's happening that we get uncomfortable with the possibility that anything could deviate from that. And I do think with for sale housing transactions, often you have to be more comfortable with the notion that you've got a budget and you're going to do your best to execute on that budget, but you need to be flexible and recognize that maybe a certain home might cost a little bit more, and therefore you're going to need to figure out how to address that. And maybe other homes will end up having to adjust so that we spend a little bit less on them. The timing might vary a little bit. I think there's unique elements. In some cases, I've done deals where the homes have not even been purchased yet on an AC rehab deal, and all we have is a budget for acquiring them with a plan to go out and buy them. And obviously that means there's the very real potential that things could move pretty significantly as we mix and match which houses are actually purchased and then the actual scope of rehab for any given house. So I think being comfortable and flexible with the notion that things are maybe not quite as 100% dialed in as the regular standard one-off new markets transaction that you're used to.
I appreciate all of those insights. And it also just kind of shows that, you described two approaches, one where you buy the land, build the homes, sell the homes, carry back paper. And that is the overall structure versus the one where you're doing a serial development. To the extent it's challenging just from a business operations perspective in terms of having the land and knowing what you think building costs are going to be in 5 years and all the rest. And also from an investor's perspective, there are a lot more moving pieces there, as you point out. So you have to basically do your compliance checking more often, because with each new development, you have to be revisiting a lot of the compliance you've already gotten comfortable with on the prior development. So it's just another reason why you see less of the serial development versus the upfront development approach. So let's go to the business. If I'm a home builder, thinking this sounds great to me, I'm building homes in low-income communities. I can get some assistance from a new market tax credit allocation to help provide homes to lower income families in distressed communities. What's not to like about that? What concern should I have?
Well, obviously there's a lot to like. So it'd be a short list of what not to like, but I think one of the first things, again, part of the fun is deciding how to deploy the subsidy. And I mentioned you can use it to buy down the price of the homes, carry back a note. If you're carrying back a note, what are the terms of that carry back note? And often you might even have an A piece and a B piece. I do think there's also some exciting decisions you have to make around what happens in the event that a homeowner struggles to make those payments. What happens if they are delinquent? What happens if they go into default? How do you go about addressing some of those more mechanical issues around servicing this debt, supporting these homeowners? And certainly that's where it helps to build in a little cushion financially, such that you don't have to have all of your notes performing 100% on time at all times, such that you can survive a handful of homeowners struggling, and your ability to help them such that you're not having to step in, foreclose, or take other dramatic and drastic actions against these homeowners. I think when we talk about that whole carryback note, especially related to any B piece that might have, say, accruing interest and or very soft debts types of terms where it may not even have any repayment requirements now, but with a plan for it to be paid at some point in the future, to the extent that loan is forgiven at some point in the future, whether it's 7 years, 10 years, 50 years from now, then you should realize that there is the potential for there to be income tax consequences to the homeowners related to that forgiveness. So that's a feature you have to think long and hard about and try to manage and make sure that your homeowners go into it with their eyes wide open, realizing that will be a feature. Although hopefully by that point in time, they'll build up some more equity, and maybe they'll be in a position such that in the chance that they do end up owing some income tax, that they'll be able to maybe refinance their loan or get a second piggyback loan to help to pay for that income tax liability. I think too, there's an element that we can sometimes lose track of that's important for every QALICB, but especially for these ones, that our QALICB loans have to be respected as true debt. And without that, if the debt isn't debt, then the QALICB is not a QALICB. And so we really have to make sure that we're structuring our deal in a fashion where our QALICB has the ability to repay the QALICB loans that it borrowed from the subsidies. And usually one of the key ways to do that is through demonstrating that the seller carryback notes are actually generating enough principal and interest payments to repay the QALICB loans. And part of the fun is timing, because usually our QALICB loans are 7-year interest only, whereas our loans to the homeowners may start amortizing immediately, although you may also choose to backload some of that amortization a little bit. I think too, it also limits your ability to just give away all the subsidy and say, I'm just going to buy down the price of all these homes, because then you end up in a spot where the QALICB's assets are so limited, so constrained, that maybe it doesn't have the ability to repay this debt, should it have to repay the debt in the future. And certainly, just to highlight a couple of structuring alternatives, one alternative that I've seen work is portion of a business notion, where QALICB is a subsidiary or a portion of a larger business. For true debt purposes, the larger business is really the borrower, so you can rely on the assets and cash flows of the larger business when it comes to repaying the debt. I found that to be helpful and beneficial. Or sometimes you can just have a larger nonprofit actually serve as the QALICB. The only limiting factor there is to the extent the nonprofit might otherwise violate the QALICB requirements, such as by having non-qualified financial property like endowments or large cash balances, or to the extent that it has operations and assets located in other areas that might not be low-income communities, that can be problematic. A few other elements since we're having fun.
Please.
I think one question is always, where am I getting my leverage? And every new markets deal have to figure out where it's going to get its leverage. A lot of these transactions might have some soft money coming in, which is helpful if it's soft money coming in as leverage. But in many cases, they also have real hard third-party lending sources. And so those terms often will dictate the underlying terms of your QALICBs, because you're going to need enough cash flowing up through your new market structure in order to service the debt that you're borrowing from this hard money leverage. And so making sure that you're able to balance those two in terms of the source of your leverage and your plans related to what's happening with the underlying homeowners is a key aspect of making this work. We talked a lot about providing future homeownership support services, but make sure it's real and not just imagined, not just aspirational, and that it's meaningful, right? And often it means not just the homeowners who buy your homes, but it might even be the broader community where you're providing ongoing classes, ongoing seminars and support to maybe even the broader community, a larger group of homeowners than just those who came out and bought your homes that the QALICB developed. If you're doing serial development, then you definitely need a sufficient pipeline. Otherwise, it's going to be really challenging once you get done with phase one to move on to phase two and have to figure out where you're going to get phase two, not to mention 3 and 4. We talked about affordability for the homes. That's a critical aspect. And then I think one last thing I'll mention, which is restrictions on who can own the homes. You think about, if I'm sinking subsidy into these homes and selling them to low-income people, do I want them to be able to just turn around and sell the homes to anyone in 6 months or a year? Or do I really want to maintain this community as a community for low-income home buyers, such that if my initial buyer ends up needing to sell in 3 years, 5 years, 10 years, that they have to turn around and resell the home to another low-income family? And if so, how do I go about enforcing those restrictions? And there's a couple of different ways you can do it, such as through terms in your seller carryback note. You can also enforce it potentially through deed restrictions, but it's important to make sure that you've thought through those so that you can build those features into your transaction up front, layer it into your legal documents, so that when the time comes a few years down the road and a family needs to sell their home, you're not caught flat-footed trying to figure it out then, but you've already got it built in and figured out when that time comes.
Great. Thank you for that, Nicolo. I wanted to turn to the buyer, but before I do that, I did just want to sort of level set for our audience. I'm sure they picked up on this already, but when we say QALICB, that is the acronym for Qualified Active Low-Income Community Business, where low-income community is the area that you're locating the business, and it has to be a low-income community. So the low-income community business is a business situated in that. So there's an extra test about, is the business in the low-income community? And then the active is, it has to be an active business as opposed to a passive business. And we've talked about that. So that's what the Qualified Active Low-Income Community Business, or QALICB term, means. And then when we use the QALICB term, that's a Qualified Low-Income Community Investment. And that's basically the CDE itself receives equity capital from a fund that's usually leveraged. And then the CDE itself takes that equity investment and makes a loan typically to a Qualified Active Low-Income Community Business, a QALICB. And that loan has qualification rules to be treated as a qualified low-income community investment. So anyways, that's your quick primer on QALICB and QALICB. But now I'm the homeowner and I'm going to buy this home. And with what we've discussed so far, I know that, I likely need to have some sort of down payment. And you can share with me to what extent homeowners end up needing down payments. I know I probably have to be low income under the 80% AMI or lower test, depending upon what the business is providing. So I have to prepare to demonstrate and provide the records to show that I'm a low income person. I need to know that when I buy the home, there could be these resale restrictions later on. So I want to know what those resale restrictions are. And I also need to understand, that whether or not there's the potential for income through debt forgiveness sometime in the future. So I've listed 4 sort of items. Are there others that you would want to call out? I know you'll call out more during the conference panel in San Diego, but anything else that I missed or something you wanted to expand on a little bit more from what I summarized?
Get ready to enjoy all the fun that comes with home ownership. And I think for those of you that haven't done it yet, it's an adventure and it's a lot of fun, but it's also a whole brand new world that you get to experience. I think too, Mike, you mentioned this notion of down payment. And I'd say in general, the group that tends to have the biggest voice around down payment tends to be the leverage lender, who often has very specific requirements there. But I also find that often the QALICB sponsor might be a nonprofit who's very focused on homeownership, but often they have access to homeownership grants. They have the ability to help the homeowners to come up with part of the down payment. So there's sort of a give and take there. And often there's definitely not a one size fits all scenario, and it's going to be deal by deal. But you're right, that is an important element of the process.
So thank you, Nicolo. There's a lot more that we could be covering in terms of using new market tax credits to support single family home ownership in distressed communities. Any last words in advance of the panel in San Diego?
I'll just remind everyone that home ownership deals are really often some of the most exciting and rewarding transactions. All the CDEs and investors that I've worked with on these deals have really enjoyed the work and seen the deep impacts that come from these transactions, both for the homeowners as well as for the community at large. And I'm sure I will see you all in San Diego. I won't personally be on the panel, but we will have some really great panelists who have tremendous expertise with home ownership transactions. We'll be excited to share with you all of their experience and insights into these transactions.
Thank you, Nicolo. We could talk a lot more about this, but I guess at least we've whet the appetite for many listeners to come to the conference next month and sit in on this session. I will link in today's show notes to the conference. I'll also include in today's show notes Nicolo's contact information. And if you're interested in new market tax credits, more generally, single family home development, more specifically, please reach out to Nicolo. Before we get to the off mic section, I do want to encourage our audience to subscribe to Tax Credit Tuesday. If you're not subscribed already, and subscribed on every one of the platforms you use to get your podcast. Don't pick just one. So please subscribe. If you're watching on YouTube, if you're enjoying these podcasts, please take a moment to like and comment on the video. It's a great way to raise our visibility and makes it more likely that others will benefit from what we discuss for free here on Tax Credit Tuesday. I also every week like to encourage everyone to share the podcast with their colleagues. That's a great way to get them started on some of the many incentives we cover, as well as to stay up to speed. And we do have a full archive of episodes available on our website at novoco.com. And you will see that a couple of years ago, we did have a podcast on new market tax credits and single family home sales. So let's turn now to the off mic section, which is always a fun place to give a shout out to others that are working in the tax credit and tax incentive communities, to highlight a professional or a group that is worthy of recognition. And there are so many. Nicolo, to whom would you like to give a shout out?
My shout out today goes out to Saurabh Narain, who is the president and CEO of National Community Investment Fund. And it's been my great pleasure and honor to work with Saurabh for over 20 years now. I think we closed our first new markets transaction together in 2004. In fact, Mike and I both worked on that transaction together. Additionally, NCIF and I have closed a couple of homeownership transactions. And I'm sure Saurabh would be excited to chat with anyone who's interested in doing a homeownership deal as well.
Great. Thank you for that shout out. I'll echo it as well. Saurabh is a real thought leader in all things community development, new market tax credit included. And as you know, adventurous enough to tackle single-family home sales in low-income single-family home ownership in low communities. And I'll also take sort of a moderator's prerogative or host prerogative, and also give a shout out to Smith NMTC. They also are one of the leaders in single-family home development and sales in distressed communities. So shout out to them as well.
And Howard will be on the panel.
Yes. So Nicolo, thank you for bringing on the podcast today. I look forward to being together with you in San Diego. It was great to see you at our Las Vegas Law Closing Tax Credit Conference just a couple of days ago, and our Opportunity Zone Summit. And then to our audience, I'm Michael Novogradac. Those of you on your phone, thanks for listening. And those of you on YouTube, thanks for watching.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.